With the Fed signaling more rate cuts could be coming this year, what does that mean for commercial real estate investing? Our next guest leads an investment firm with a portfolio focused on the space. Let's bring in Peachtree Group CEO Greg Friedman. Greg, I should say, it's great to have you on this afternoon. And especially in light of the Fed walking back somewhat from the deep cuts we thought were coming, does that have you a little nervous?
Yeah, I mean, I think there's no question, everyone, was surprised to see that we got 50 basis points of rate cuts. I think everyone was expecting the next couple of meetings we'd probably see, potentially 25 basis points or more in rate cuts. I don't think that's the case. We've been pretty consistent over the last couple of years that we think we're just in a higher interest rate environment for longer. I was a little bit surprised that the Fed did reduce rates last time by 50 bips. I think there's still the risk of inflation. And unfortunately, just as rates, you look at the long-term rates, the 10-year Treasury's up since the last rate cut. That really has a negative impact to the underlying values of commercial real estate because, ultimately, there's risk premium spreads which apply to the cap rates on how assets are valued, and that has a very negative implication.
So, do you have office in the portfolio? Are you more real estate? Where's your exposure?
Yeah, I mean, we have some office. We don't have a lot of office. We're focused, primarily, we invest both on the credit side as well as the equity side of commercial real estate. We have, everything on the credit side from multifamily to office, retail, hotels. We have horizontal land development loans. On the credit side, the equity side, we have a huge exposure to hotel assets. We also have some office, not a lot of office, but fortunately, office is going through a bifurcation right now, as you know, and not all office is bad, but a lot of office is struggling.
Yeah. So what has been doing the best in the portfolio and where are the drags?
Yeah, so, across our portfolio, hotels have rebounded extremely well. Hotels are doing, extremely well. Multifamily, from a fundamental perspective, continues to do well. It's office that's, got the most stress, or really the secular distress that you're seeing. I think across all commercial real estate, you're dealing with this downsheet stress of just higher rates that are having a negative impact to cash flows, just increasing the cost of debt, and that's where you're seeing the stress across our portfolio is just the impact of dealing with higher rates. Fortunately, we don't across our equity portfolio, at least we don't carry a lot of leverage. We carry moderate leverage, so we're able to sort of maintain through this process. But there's no question, I think being a credit investor is a great place to be today. But go ahead.
Yeah. So I guess my question is around higher rates. And even though rates are coming down, we've been waiting for this moment where refis have to come through. And, I saw a couple downgrades in Simon Property Group in the mall space. Again, not because these refis for them, they've got a $2 billion refi coming up due, but that was at 265. At some point, this does affect FFO. And there are headwinds with some of these dynamics. We've yet to really see where, higher rates, although they are coming lower, are still significantly higher, which was the premise in which a lot of this stuff sold off. Meanwhile, a lot of these, if you look at some of the mall REITs, I mean, they're trading at multiples that are above historical. And in that sense, I feel like they've been given not only a pass on higher rates, but the prospect of lower rates has allowed them to trade to a premium.
That's right. And I just don't see rates, like look at the 10-year Treasury today, to your point, it's around 4%, a little over 4%. If you look at the decade pre-2022, the 10-year average closer to 2%. So it's double where we were. So the reality is a lot of cases people think, we're going back to this lower interest rate environment, and effectively we've entered a new game. We've entered a new, just rate regime in the sense that, the 10-year we expect to stay, at least, in the mid threes, maybe higher when you look over the next 5 years, because we're just in a higher period of inflation from our perspective. And that's going to be, that's a negative headwind to, being able to drive cash flows if you have leverage, underlying, leverage that's, applying to these assets, and you're refinancing at a much higher interest rate that in a lot of cases is, almost double what you were paying before.